Hello, good morning and welcome to ET Now's The Newspaper Show with me, Varun Hiremath. Before we move on any further, let me remind you that the newspapers are completely safe. Any rumors you've heard revolving around the contamination of the COVID-19 virus through the newspapers is completely false. And let me assure you that all the personnel and staff at the presses are taking the utmost care with social distancing as well as PPE measures. So if you are interested in getting your newspaper delivered to your residence once again, please go to wantmypaper.com where you can explore all the options available for newspaper delivery to your residence. With that being said, let's now surge forward the top 10 stories of this morning, beginning with Apple may be exempt from 100% import check. India plans a list of nations for critical imports. India set to ramp up infra along China border. Curbs on expenditure to continue in Q2, says the Finmin. JSW seeks time till March to close the BPSL deal. HUL to drop fare from Fair and Lovely. EPFO may slash FY20's interest rates. Centre plans 2-week monsoon session. Google to pay some publishers for content. An ancient drug bought into the COVID battle. Okay, the top 5 corporate stories for this morning. Electronics, phone companies hike prices by up to 12%. MNCs in India may get royalty from the parent. Best of HDFC Bank yet to come, says Aditya Puri from the annual report. Government plans 15 to 25% duty on solar gear imports. And Team India may lose kit partner Nike. Okay, let's move on to the market stories as well. SEBI eases preferential issue pricing norms. Wall Street recoups losses, oil drops. Rollovers hint at limited upside for Nifty. Nifty companies interest coverage ratio at a 6-year low. And foreign investors stay put, hike India outlays. Alright, now that we've gone over the headlines, let me go on to the first story for this morning, which is on page 1 of the Economic Times. And non-China companies like Apple, so ET suggests, or reports rather suggest, that foreign companies such as Apple that import finished goods or inputs from China to India can be spared the 100% physical check of shipments from that country. Remember, the heightened scrutiny of Chinese imports is followed by border tensions between the two nations and the move to reduce India's business and trade ties with its neighbor. So it looks like we're trying to safeguard our supply chain on all the various fronts, and as a result of that, our dependence on China might be getting lower and lower. Okay, the next one for this morning, also on page 1 of the Economic Times. The creation of a new post and infrastructure in Galwan Valley is believed to have cut off the traditional access to Patrol Point 14 on the line of actual control, making the strategic Wainala near the Shyok Ganwal axis the new frontier for Indian and Chinese troops. So there's been some realignment over there, as you just heard. Please do have a read, page 1 of the Economic Times, if you are interested. Okay, the next one is talking about substitution. Again, page 8, but of the Economic Times. Reports suggest that India is working on a list of alternative countries that could be suppliers of critical components that cannot currently be manufactured domestically. Reports say that the Department for Promotion of Industry and Internal Trade is working with the industry to line up a list of low-quality imports from China. The next step is to substitute them internally or externally. Once the DPIIT is ready with the list, the government will reach out to countries and work out ways to incentivize supply to the Indian market, even as it tries to encourage domestic manufacturing of the same goods. So that's quite interesting. Page 8 of the Economic Times. Do have a read. Okay, we're now going to bring some of our researchers on board. It's page 11 of the Economic Times. Power and Renewable Energy Minister R.K. Singh says that the government is planning to impose a basic customs duty on imported solar modules from the 1st of August, which would eventually be raised going forward. Vivek is my colleague who's with us now. Good morning, Vivek. Welcome to the show. Tell us what this means for the respective companies.
Good morning, Varun. So very interesting development. This has been in talks for quite some time. So what the ET is reporting today morning is that they're saying that a 40% import duty on solar gear is likely within a year. So what they're basically going to do is that the government is planning a 20 to 25 basic customs duty on solar modules and a 15% duty on cells, and this could happen as early as August 1st itself. Now, one very interesting trend, and that will probably explain why they're looking at such a high import duty, is that have a look at the kind of share that China has as far as the import of solar gear is concerned for India. So from FY17, while the share has been marginally increasing, FY17, the share of Chinese imports in this particular segment was a little over 88%. It's come down quite significantly to 77%, but still, standalone, when you look at 77%, it's an extreme figure. And this doesn't really go well with the theme of Atmanirbhar Bharat. So overall, a lot of the companies that do make solar gear, a Voltamp, a BHEL, even some amount of L&T, all of these stocks would benefit from the kind of high duty that will now be levied. It'll be interesting to see how exactly these stocks would now start reacting and how they start pricing in higher sales, if likely for them.
All right, Vivek, thanks so much for joining us this morning and really breaking it down regarding who the parties are who might benefit or not and exactly what it's going to do to their costs. So thanks again for joining us. Let's move forward. Coming to the steel sector, we have Mobina with us. Sajan Jindal-led JSW Steel has asked for time until March next year to complete the acquisition of Bhushan Power and Steel as part of the insolvency resolution plan. Good morning, Mobina. Welcome to the show. We don't usually hear from you this early. It's nice to have you here. Could you walk us through what this really means for JSW and also for other steel players?
Hi, Varun. Morning. So we need to understand over here that this was an IBC case. JSW Steel had won the NCLAT approval to acquire Bhushan Power. Now, this was last year. The only step left now for JSW Steel was to pay up roughly about 19,000 crore rupees to complete this court-approved resolution plan. That's the acquisition of Bhushan Power, which, mind you, has been mired in a lot of legal controversies as well. Now, they had missed the earlier deadline, which was back on the 17th of March, to make this payment, because there's a certain timeline. Now, the COC could actually move to penalize the officials of the corporate debtors seeking, this sort of imprisonment, or they may even ask for a payment of a huge penalty or a hefty amount. However, it looks like now that JSW Steel has sought even more time to make this 19,700 crore rupee payment. Remember that this was largely being funded by any which ways taking fresh debts. And it had already been through a very long litigation. But then we had the pandemic that hit the country, right? And we obviously know what's been happening to economic growth, which the steel sector is very highly dependent on. And hence, JSW Steel as well was caught in the crossfire. It obviously has its expansion plans as well that it has to fund, which, by the way, it has already delayed. And now, of course, this hefty 19,000 crore rupee payment. So for now, they have asked for an extension. But of course, it's absolutely important that they finish making the payment, or it's not going to go down well with the NCLAT. In fact, from all the more popular IBC cases that we know that have been acquired by the larger companies, this perhaps may be the first time that, the company will be unable to go through with the transaction.
All right, Mobina, thanks so much for breaking that down for us. It's also so interesting. A delay in this resolution or purchase is going to also throw off a lot of lenders who've been talking about recoveries coming in from this same, perhaps linked to this payment. So it'll be interesting to see how some of those creditors also respond. But thank you so much again for joining us. Let's move forward. Traders may be expecting limited upside from current levels in the July derivative series if trends in rollover of futures contracts and build-up of positions are to go by. After the 8% jump in the Nifty in June series, traders have been less enthusiastic about carrying forward long positions. Jayesh joins in. Good morning, Jayesh. Welcome to the show. Take it away.
Good morning, Varun. Rightly mentioned that, despite the 8% move in the Nifty for the June series, which expired yesterday, traders are in fact less enthusiastic about carrying forward long positions. And analysts believe that, there could be resistance going forward near the 10,500 to 10,600 levels. Now, this is despite the rollover picture being extremely good and positive. In fact, the rollover for the June series has been higher than the 3-month average that we've got. However, analysts feel that the indices will be facing resistance at higher levels because there is lack of clarity on how much the economy has picked up after reopening, and therefore the analysts are advising caution at higher levels. A few of them, have given levels as well. Yogesh Ratke of Edelweiss believes that the range for the market in the July series could be extremely wide, from the lower end being 9,400 to the upper end being 10,600. On the other hand, Amit Gupta, who is the head of derivatives at ICICI Direct, believes that the range for the market could be as narrow as 10,000 to 10,500. So extremely varying views coming in, while you have Chandan Taparia of Motilal Oswal believing that the Nifty range could be 9,700 to 10,700. So one common point out of all of these recommendations or analysts' expectations, 10,500 to 10,700 seems to be a good resistance level, and that's the reason that market participants are expecting the July series to be a little on the lighter side.
Jay, just stick on with us for 1 second. So based on these different views that you've got, do you necessarily think that there's any one range which is more likely, or would you say you'd have to wait and watch?
So Varun, the data that I have been tracking, of course, just to give you one more additional data point, the FII net long position has been reduced to 42% at the start of the July series, which is comparatively extremely lower than the 63% that we had for the June series. And the May series also was in excess of 60%. So this is the first time 3 series that we are starting on a lighter note as far as the FII net long position is concerned. Also, the market movement of last couple of weeks, in fact, has clearly demonstrated that 10,500 has proved to be a resistance for the Nifty, while 22,000 to 22,500 on the Nifty bank has been a clear resistance. So, I would agree with the analyst view that, the downside, of course, we would not know, but there is clear resistance at the 10,500 to 10,700 mark.
All right. So Jayesh and other experts also say tread carefully as we go into July. The markets seem that they may be reaching a critical resistance. Thanks so much for joining in, Jayesh. Appreciate it. Let's move forward. Page 11 of the Economic Times, looking at curbs on expenditure. So according to this ET report, the Finance Ministry has disallowed the automatic carry forward of unspent money by various ministries and departments over the next month or quarter. Now, this is as part of the government's spending management aimed at curbing unnecessary expenditure. So that's quite self-explanatory. Page 11 of the Economic Times. It's about conservation of capital right now. It doesn't matter whether you're the government, a bank, a company, everyone's really aligned with the same thought process. Okay, we're now switching gears for a moment to the Times of India, business page 13. The Finance Ministry has initiated steps for a one-time restructuring for businesses that were viable in the pre-COVID period, but are struggling under the weight of the pandemic. Poonam joins us now with more details. Over to you, Poonam.
Well, reports suggest that the FM is looking into an option to allow one-time restructuring of loans which were viable before the pre-COVID period. Now, do note that the RBI has already allowed a moratorium until August in terms of in terms of payment of interest or installments rather. But do know that a moratorium is only a deferment of payment, and a borrower certainly has to pay the interest as well as the principal at least by March of 2021. Why is a relief needed and why the need for a restructuring? Well, essentially, yes, a moratorium is a deferment of payment. Cash flows of the businesses have been certainly impacted, and hence borrowers do require the relief in terms of allowing a restructuring, because that will allow them to restructure the installments, that will allow them to even restructure the terms of loans of repayment and possibly even rate of interest. In fact, one of the reasons is the fact that bankers also, if at all a loan is restructured, bankers do not have to classify those loans as NPAs, and hence that saves them from making additional provisions on the loans. Now, will it really see the light of the day? We will really have to see, because do know that why RBI has been reluctant is because in 2008, when they did allow one-time restructuring, it led to huge amount of NPAs into the system, and RBI in 2014 had to ask bankers to classify the restructured loans as NPAs. Will we see one-time restructuring or not? Well, we will have to wait and watch out for that.
All right, thanks for that, Poonam. Let's switch gears a little bit. Hindustan Unilever is dropping the word fair from its iconic skincare brand Fair and Lovely. This decision has come in amid global outrage and anti-racism protests triggered by the police killing of an African American in the US last month. The top product in its own segment has been criticized over the decades. HUL's remarkable decision has put its rival companies in a dilemma. Neha Tyagi joins in with more. Let's listen in.
Well, I think it's fair to say that Fair and Lovely is finally fair. Hindustan Unilever has taken a major decision to rebrand its flagship brand Fair and Lovely and has decided to drop the word fair from the name. The company said that they're currently awaiting regulatory approvals and that the products with new packaging and name will hit the markets in the next few months. HUL said that over the last 1 decade, the communication for Fair and Lovely brand has changed to represent empowerment of women. In 2019, HUL removed the two-faced cameo as well as the shade guides from the packaging of Fair and Lovely. Globally as well, Unilever has announced commitment towards creating a skincare portfolio that is more inclusive and celebrates diversity of beauty. Unilever said that they would stop the use of words fairness, whitening and lightening for all of their products. All of this, of course, follows Johnson & Johnson's decision to also discontinue product lines under the brands Neutrogena and Clean and Clear last week. All of this is a result of the backlash that cosmetic companies across the world are receiving in the light of the Black Lives Matter movement that has taken the Western world by a storm. In India also, we are quite open when it comes to our obsession for fair skin and for lighter skins. We did reach out to several brands. Imami responded by saying that they're currently evaluating internally.
All right, thanks for that, Neha. The SEBI has relaxed pricing rules on preferential offers for all companies and has allowed open offers through stock exchanges in a series of measures aimed at helping India Inc. raise money amidst its economic downturn. SEBI has also streamlined insider trading norms at its board meeting yesterday. Utkarsh joins in with more details on this story. Over to you, Utkarsh.
Two major changes done by SEBI today are in the board meeting. First one is relating to the pricing of preferential issues. Second one is about open offer and takeover regulations. Let's speak about the preference issues here. What the SEBI release says is that due to serious challenges faced by the corporate sector in the wake of developments related to COVID-19, SEBI has been receiving numerous representations from stakeholders for liberalizing regulations relating to raising capital from security markets. And then what they say is that in case of frequently traded shares, the price of the equity shares to be allotted on the preferential issue shall not be less than, and let me break it down for you, what do they mean? Shall not be less than either the 2-week weekly average price of the share or the 12-week weekly average price of the share, whichever is higher. You can't go below that. That is the fixing mechanism, the price fixing mechanism of preferential issue, and this price has to be locked in for the period of 3 years. Now let me come to the takeover regulations here, which say that acquisition through stock exchanges through bulk and block deals shall be permitted during open offers. This is something which was not allowed earlier. Secondly, in case of indirect acquisitions, in the open offer, 100% of the payable amount under the open offer must be deposited 2 working days before the date of the detailed public statement. And in case of a delay of an open offer, you will have to pay a simple interest of 10% to shareholders who have tendered the shares in the open offer. These two are the major ones. Then there are some amendments to the insider trading regulations where you have to make more disclosures, but these two are the major ones which the market has been looking for.
All right, thanks for that, Utkarsh. Really interesting. Do have a read.